The silver market is broken. Here's what they don't want you to realize. Right now, somewhere in a boardroom you will never see, a decision is being made about your money, not your bank account, not your savings, your future. They are calling it a correction, a simple dip, nothing to worry about. But what if the very people telling you to stay calm are the same people quietly buying everything you're being told to sell? What if this crash you're watching, it was never a crash at all? What if it was a door, closing slowly, on purpose, right in front of you? By the end of this video, you will understand exactly why silver is moving the way it is right now, and why the next 90 days may decide who builds real wealth, and who simply watches it happen to someone else. Now, before we go any further, I want to ask you for something. Just one small thing. If you've been with us a while, if these videos have ever made you pause, think twice, or look at your own savings a little differently, would you do us the honor of hitting that subscribe button? It costs you nothing, but it tells us you're still here. It tells us this work matters to someone. Think of it like checking in on an old friend. And while you're at it, tell us in the comments, where in the world are you watching this from today? We read every single one. Now, let's get into it. You said, write 800 words for part 1. The story must be interesting and keep the audience engaged. For months, the story was simple. Silver was rising, gold was rising, and the people who got in early were celebrating like they had found a secret the rest of the world had missed. Prices climbed faster than almost anyone expected. Silver pushed past levels that analysts had once called long-term targets. And it did it in a matter of weeks, not years. Gold followed close behind, breaking records that had stood for years. Then suddenly, the mood changed. The same charts that once pointed straight up began to bend downward. Silver, which had been flirting with $50 an ounce, started slipping. Gold, which had been celebrated as the ultimate safe haven, pulled back from its highs. Headlines that once praised the rally now warned of a bubble bursting. Commentators who had been silent during the climb suddenly found their voice during the fall. To the average investor, this looked like panic. It looked like the party was over. But to those who study markets closely, something else was happening. This was not a random accident. It had the fingerprints of something more deliberate. A pullback that, in many ways, behaved exactly the way these things are supposed to behave when too many people rush in at once for the wrong reasons. Here is what most people did not understand. When an asset rises quickly, it attracts two very different types of buyers. The first type studies the fundamentals. They understand debt cycles, currency printing, and the slow erosion of paper money. They buy with patience, holding through ups and downs because they believe in the long-term story. The second type buys because they saw a chart going up and did not want to miss out. They are driven by excitement, not analysis. They buy at the top, talk about it constantly, and panic the moment prices fall. It was this second group that fueled the most dramatic part of the recent rally. Stories spread of silver hitting $200 any day now. Predictions multiplied. Confidence became overconfidence. And when prices began to slip, that same group became the first to sell, often at a loss, convincing themselves they had simply made a mistake. This is where the deeper story begins. Markets like this rarely move in a straight line. They climb, attract a wave of emotional buyers, then pull back sharply to shake those buyers out before continuing their longer journey. It is not kindness. It is not coincidence. It is simply how cycles tend to behave again and again throughout history. There was another layer to this story, one tied not to charts, but to power. Political pressure on central banks had been building for months. There were public threats aimed at the people who control interest rates, suggestions that anyone unwilling to keep money cheap and policy loose might not keep their position for long. This mattered more than most people realized. When the people who control a nation's money supply feel pressured to please those in power rather than follow sound economic judgment, the value of that money becomes less certain. And when currency becomes less certain, hard assets like silver and gold often become more attractive over time, even if the path to get there is not smooth. So while the headlines focused on the dip itself, the more important question went largely ignored. Why was this happening now, and who actually benefits from a sudden wave of fear? History suggests an uncomfortable answer. Pullbacks like this tend to separate two types of people. Those who panic and sell at exactly the wrong moment, and those who view the chaos as an opportunity, quietly increasing their position while everyone else is busy being afraid. Few were saying it directly, but the pattern was becoming difficult to ignore. The smart money, as it is often called, was not running from silver. It was waiting, watching, and in some cases, beginning to buy. This is where the real story of this moment begins, not with fear, but with a quiet, calculated patience that most people watching the headlines were not prepared to recognize. There's a strange thing that happens during every major market pullback. The loudest voices disappear, and the quietest ones start moving. Anyone who has studied financial history long enough has seen this pattern before. It is not new. It is not unique to silver or gold. It happens in real estate, in stocks and currencies, and in nearly every market where fear and greed take turns controlling the wheel. During the climb, everyone wants to talk. Social media fills with predictions. People who had never owned a single ounce of silver suddenly become experts, sharing charts and confident forecasts. But during the fall, something changes. The same voices that were loud just weeks earlier go silent. Not because they stopped caring, but because many of them sold. And there is little excitement left in explaining a loss. Meanwhile, a different group behaves in almost the opposite way. They were never loud to begin with. They did not post countdown timers to $200 an ounce. They simply accumulated slowly, without fanfare, treating each dip not as a disaster, but as a discount. This is the divide between what can be called economically active behavior and economically passive behavior. It is one of the simplest ways to understand who tends to build wealth over time and who tends to watch wealth slip through their fingers. A passive participant reacts to headlines. They buy when excitement is high and prices are already stretched. They sell when fear takes over and prices have already fallen. Their decisions are driven by emotion, not analysis. They are, in a sense, always arriving late to the party and leaving early from the recovery. An active participant studies the underlying forces. They ask why prices are moving, not just how far they have moved. They understand that price and value are not always the same thing. When fear pushes the price of something below its real underlying worth, that gap becomes an opportunity rather than a warning sign. This explains why so many experienced investors describe periods like this not as dangerous, but as necessary. They are not hoping for chaos for its own sake. They are simply aware that without occasional fear, prices would never become attractive enough to buy in serious quantity. A market that only goes up, without ever testing the patience of its holders, rarely lasts. The pullback is uncomfortable, but it is also part of how sustainable long-term gains are eventually built. There is also a more controversial idea worth considering. Some of the very people now warning the public about further declines may not be acting purely out of caution. Fear, when communicated convincingly, has its own value. It can shape behavior, encourage selling, and create exactly the kind of environment in which patient buyers prefer to operate. This does not require any grand conspiracy. It only requires understanding that attention in financial media is often driven by emotion rather than nuance, and emotion sells far more reliably than patience does. This is precisely why so many seasoned voices in the metals world have grown quiet about short-term price targets and far more vocal about long-term direction. They speak less about where silver will be next month and more about where currencies, debt levels, and monetary policy are heading over the next several years. It is a subtle shift, but an important one. It suggests a focus not on timing the bottom perfectly, but on positioning correctly before the next major move begins. There is one more detail worth noting. Throughout history, when interest rates are expected to fall and money becomes easier to access, the appetite for hard assets like silver and gold tends to grow, not shrink. Easier money usually means more currency in circulation, and more currency in circulation usually means each unit of that currency is worth slightly less over time. Silver does not care about headlines. It does not care about social media sentiment. It simply exists as a finite resource in a world where the supply of paper money continues to expand. This is the quiet, calculated thinking now taking place behind the scenes, far away from panic-driven headlines and dramatic predictions. While most of the public watches price charts and reacts emotionally to every red candle, a smaller, more disciplined group is doing something far less exciting, but historically far more effective. They are simply waiting, watching, and preparing to act, while everyone else is too afraid to move. There's a question almost nobody outside financial circles is asking right now, and it may be the most important question of all. What happens to the value of money itself while everyone is busy arguing about whether silver will rise or fall next month? This question matters because the forces shaping the next several years have very little to do with short-term price charts. They have everything to do with how much money is being created, where that money is being spent, and what happens to its value once it is released into the economy. Consider what is currently taking shape. Massive amounts of capital are being directed toward bringing manufacturing and industry back onto domestic soil. At the same time, an enormous wave of investment is pouring into artificial intelligence, data infrastructure, and the energy systems required to power it all. These are not small, temporary projects. They require years of sustained spending, vast amounts of electricity, raw materials, and labor. None of this is cheap, and very little of it is being funded through savings alone. When governments and corporations spend at this scale, the money supply tends to expand. New currency enters circulation to fund new projects, new factories, new infrastructure. This is not a controversial economic theory. It is simply how large-scale spending has worked throughout modern history. And when the supply of currency increases faster than the supply of goods and services in an economy, the result is inflation. Prices rise, not necessarily because demand for any one item suddenly increased, but because each unit of currency buys slightly less than it did before. This is where the trap becomes dangerous, particularly for those who consider themselves cautious. Many people believe that holding cash during uncertain times is the responsible choice. It feels safe. It feels conservative. But in a period of sustained inflation, cash sitting still is not actually safe at all. It is quietly losing purchasing power every single day, even while the number on a bank statement remains exactly the same. This is precisely why hard assets behave differently during inflationary periods than during calm, stable ones. Silver and gold cannot be created at will by any government or central bank. Their supply grows slowly, limited by what can be mined and refined each year. While currency can be expanded with a few keystrokes, silver cannot. This basic difference becomes far more important during periods when money is being created faster than goods and services can keep pace. There is also a second layer to this story, one tied directly to industrial demand. Unlike gold, silver is heavily used in real physical applications, including electronics, solar technology, and the growing infrastructure required to support artificial intelligence systems. This means silver is not simply a store of value sitting quietly in a vault. It is a material actively consumed by the same industries currently expanding at a historic pace. Rising industrial demand, combined with a finite supply and an expanding money supply, creates a very specific kind of pressure, one that tends to build slowly and then accelerate once it becomes impossible to ignore. Most people watching short-term price movements are missing this larger picture entirely. They are reacting to a 10% pullback while ignoring a multi-year trend that has historically rewarded those who understood it early. This is not a story about a single month or a single headline. It is a story about what happens to the value of money itself when massive spending becomes unavoidable. The uncomfortable truth is this: staying passive during an inflationary period does not protect wealth. It slowly erodes it quietly, without alarm bells, without dramatic headlines, simply through the steady decline of what each dollar can actually buy. Those who recognize this distinction early are not reacting to fear. They are positioning themselves ahead of a trend that, historically, very few people see coming until it has already arrived. Every major shift in financial history leaves behind two kinds of people: those who saw it early and prepared, and those who only understood what happened after it was already over. The story of silver right now is shaping up to follow that same pattern, and the difference between these two groups rarely comes down to luck. It comes down to discipline. The temptation, after watching prices pull back, is to think in extremes. Some assume the rally is finished entirely and walk away discouraged. Others assume the bottom has been found and rush in with everything they have, hoping to catch the next move perfectly. Both approaches share the same flaw. They are driven by emotion rather than structure. A more disciplined approach looks very different. It does not attempt to predict the exact day prices will turn. It focuses instead on position size, patience, and diversification. This is the difference between someone who treats silver as a single, all-or-nothing bet and someone who treats it as one part of a broader strategy designed to perform well across many possible outcomes. History offers a useful lesson here. The investors who suffer the most damage during volatile periods are rarely those who held a reasonable, well-sized position. They are usually those who concentrated everything into one asset, convinced it could only move in one direction. When that asset moves the other way, even temporarily, the emotional and financial damage can be severe enough to force a sale at exactly the wrong moment. A wiser approach spreads risk across multiple related assets, allowing silver, gold, and other resources to each play a role without any single one controlling an entire financial future. When positioned this way, a pullback becomes far less threatening. It becomes simply one piece of a portfolio adjusting rather than a single, irreversible mistake. This is also where patience becomes a genuine advantage rather than a passive virtue. Waiting for volatility to settle, observing how price behaves after the initial panic fades, and gradually building a position over time tends to produce far better outcomes than attempting to time a perfect entry in a single moment. Those who build positions steadily, even slowly, are often far better positioned than those who wait for certainty that may never come. There is a broader lesson within this entire story, one that extends beyond silver itself. Periods of fear and uncertainty are rarely permanent. They eventually pass, replaced by renewed confidence, and often by regret among those who allowed fear to dictate their decisions. The businesses, entrepreneurs, and decision-makers who treat turbulent periods as a temporary phase rather than a permanent condition tend to be the ones who emerge from these cycles in a stronger position than when they began. The real danger in this moment is not the pullback itself. Pullbacks are a normal, even necessary, part of any long-term cycle. The real danger lies in complacency, in assuming that nothing important is happening simply because the headlines have grown quieter or less dramatic. While public attention drifts elsewhere, the underlying forces driving long-term demand for silver, industrial expansion, monetary policy, and persistent inflation continue moving forward regardless of who is paying attention. This is the quiet window now open. Not loud, not urgent in the way headlines often demand, but significant nonetheless. History suggests that windows like this rarely stay open long enough for everyone to notice in time. Those who recognize it now and act with patience rather than panic are the ones most likely to look back on this period not with regret, but with quiet satisfaction. You said, write a highly SEO-optimized YouTube video description of about 150 words.